Hey guys, Brian Stevens here over at the National Real Estate Post. Do you want to know who's here for you in these trying times?
Oh, okay. Yeah.
These very difficult mortgage and real estate times.
I want questions answered.
It's our good friends over at Oaktree. They run their company like a family, not the Costa Nostra, but an actual family.
I got family.
Listen, they're always conscientious of their rates, and they've got great programs. Look at their DSCR. They've been doing it longer than anybody, and their bank statement loan is remarkably underutilized. If you want to put together a plan of attack to learn how to use these products and then go ahead and market these products, an account rep would love to talk to you. All you got to do is give these guys a call and set up a time. Click this banner right over there. Oaktree for your non-QM. Trust me on this one. Now, yesterday for me felt like the official beginning of a new market. The market with higher interest rates, less demand as a result of higher interest rates, a slowing of property values, and probably the unofficial beginning of the recession that everybody knows is coming. It's not a surprise here. You know, a couple of days ago when the Dallas Fed said that we are heading into a housing bubble, I laughed about the whole thing. I think we all kind of laughed about it. Yet based on what we saw from the Fed board just yesterday, it's now apparent that we didn't know that the Fed was going to be the governing body playing the role of Grand Marshal over the volley of missteps that we are about to undertake as an industry.
Really?
First of all, Fed Governor Lael Brainerd, this gal right here, said Tuesday that the central bank could start reducing its balance sheet as soon as May and would be doing so at a rapid pace. A rapid pace. Way to spook the markets, Lael. Now, to fully understand what she's talking about, let's take a look at the Fed balance sheet. You'll note from 2003 to 2009, right in the middle of this recession, the recession, by the way, is depicted here by the gray vertical bar that you're looking at. Now, you'll note that the Fed balance sheet was basically non-existent up until 2009. But in the middle of that recession, the Fed added to their balance sheet to get us out of the recession. You get it? They added to get us out of the recession. Then from about 2009 to 2021-ish, the Fed kept adding to the balance sheet, buying our mortgage-backed securities. But in 2021, guess what? Another recession.
What?
So once again, the Feds added to the balance sheet to get us out of that recession. Added a bunch, they did.
This is not okay. This needs to stop now.
Now from 2021 to present, they've just added and added and added, and now the Fed's balance sheet is sitting at, I can't believe I'm saying this, $9 trillion. Almost as much money as the rest of the world collectively has. That's serious here. Now, I've done this before to illustrate the magnitude of what a trillion actually is. Get this, 1,000,000 seconds is about 11.5 days. 1,000,000,000 seconds is 31 3/4 years. 1,000,000,000,000 seconds is 31,710 years.
What year is it?
So now the Fed has $9 trillion on its balance sheet, and they're going to offload a lot of that faster than they previously said they were going to do, once again spooking the markets. Now, this is a problem with respect to mortgage interest rates. We've seen rates rising, buying power shrinking, inflation rising, lates and foreclosures rising, and now to me, it looks like the Fed, with their actions, is trying to put out the house fire with a hose that sprays gasoline by reducing their balance sheet and all but ensuring that rates are going to go up faster than there are right now. The second point here is the Fed Governor Lael Brainerd also indicated that interest rate hikes could come at a more aggressive pace than the typical quarter percentage point increments that they've been doing. Once again, way to spook the markets, Lael. Now, we already heard from the Feds a couple of months ago that we're going to have 6 raises over the next 6 meetings, and now the indications from the Fed chief is we're going to see quicker and or higher raises than those already aggressive rate measures that we've known about for a couple of months. So what does this all mean? Well, all your adjustable credit is going to go up, including credit cards, meaning silver lining here, guys, is a cash out refinance right now. It's going to be better than doing it tomorrow. It goes something like this. Hey guys, Brian Stevens over here with ABC Mortgage. Rates are on the rise right now. All types of rates, not just mortgage rates. Now is a great time to get a lower mortgage payment than you'll get in the next 6 months. So use this opportunity to do a debt consolidation refinance so you can pay off those credit cards, automobile, installment, revolving, whatever type of debt before some of those rates have a chance rates to go even higher than they are right now. That type of conversation would be good for a loan officer. Here's the point I want to impress upon you. As I just showed you, when we have a recession, the feds add to the balance sheet to get us out of said recession. We are on the verge of going into a recession, and this time, bucking history, we are aggressively reducing our balance sheet, a move that logically suggests that the pending recession is going to burrow deeper, bite harder, and hurt more than our recent recessions. All traditional and reliable indicators tell us that the health of our economy is so unbelievably out of whack at this point that any move is going to be subject to scrutiny because nobody truly understands how to deal with the predicament that we find ourselves in right now. Nobody. These are uncharted waters that we're in. Our economy has been on a metaphorical drinking bender for quite some time now, and right now is either the time to suck it up and deal with a hangover or do what we've done in the past, and that's to pour a little hair of the dog and keep riding this thing. Right now, the Fed's got the tough love approach, so it's time for us to white knuckle this thing and deal with a hangover. I'm just wondering how painful this is going to be. Now, the good news is the quicker we go into this recession, the quicker we get out of it, and that means rates will come back down once again. How long? Who knows?